Welcome to the ETF Show, taped right here at the New York Stock Exchange. I'm your host, Kristen Myers, ETF Editor-in-Chief of Asset TV. Now, markets, particularly energy and oil, have absolutely rocketed after the United States and Israel committed strikes on Iran. Take a listen to some of these stats right now. Oil prices have surged, topping $84 a barrel for Brent crude and $77 for WTI crude. Now, Iran recently announced that it had closed the strategic shipping chokehold, the Strait of Hormuz, which raised market anxiety even more. To discuss, we're joined now by Lance McGray, Managing Director and Head of ETF Product at Advisors Asset Management. Lance, thanks so much for joining us.
Thanks for having me.
So there's been a lot happening in the news, so to speak, over the last couple of days. This U.S.-Iran conflict now entering its fourth day. As I just mentioned, we're seeing these oil prices really surge after especially Iran said that it was going to be closing that Strait of Hormuz. I'm wondering how important that closure could be, and this conflict really generally is to oil prices and even from the wider market perspective.
Yeah, absolutely. The news that has come out this morning where Iran is threatening to shut down the Strait of Hormuz is obviously front and center for most, right? We're talking about supply chain disruptions, right? I don't think people understand how important that region is, and specifically that Strait of Hormuz is, because you're talking about 10 to 20 million barrels of oil a day coming through that very small area. So again, the supply shortage is going to be something that's front and center for most. As you mentioned, we saw a spike in oil prices already, and that's something that we expect over the next few months. That is going to essentially extend. And to be honest with you, some people are calling for oil prices over $100 a barrel, very similar to what we saw when Russia attacked Ukraine. Oil prices well into the hundreds. So that's something that we're keeping an eye on, certainly moving the needle. I would say it's not necessarily just oil as well. When you look at liquid natural gas, that area produces nearly 20% of the natural gas in the area as well. So when you're thinking about Europe, when you're thinking about Southeast Asia, these regions rely on that energy that comes through that region. And this is going to be a real disturbance when you look at supply chains and disruptions.
What is the risk of that $100, a barrel price, or even higher, as you mentioned, really to equities, to ETFs?
Well, I think in terms of the world of ETFs, and when you think about investors, right, U.S. domestic investors, those that are focused here domestically, the U.S. is a net exporter of energy. Right. So there is some cushion there. Right. But when you talk about regions in Europe, and as I mentioned, Asia and the Gulf region, this is going to put a tremendous amount of stress on those regions. So I would anticipate that we are going to see, obviously some shifting in allocations of exposure into those regions. Now, international and emerging markets has seen a really large uptick at the back half of 25 and 26. And this has the potential to sort of rein that in and sort of stall that gains, if you will. But here, at least domestically, we have a little cushion. U.S. equity markets have been fairly resilient. Markets have sold off a little bit this morning. But I think for the most part, most markets, not only the equity market, but also the fixed income market, has sort of weathered the storm rather nicely so far.
Okay, the couple of things you mentioned there, I actually want to get to all of them. So let's start on that fixed income point, because we saw the pretty predictable flight to safety, right? Whenever you see this sort of news, you always imagine that folks flee right into treasury bonds and treasury bond ETFs. But now the 10-year treasury yield is actually up over 4%. Why do we see bonds selling off despite this geopolitical tensions? The bond market's not reacting as I would expect it to.
No, you're absolutely right. And I think a lot of people would expect the same thing. And I think what this is really comes into play of inflation, right? What's going on here, right? You have equity sell off, you have bond sell off. If you're looking for safe haven, what we've seen thus far in the world of ETFs is really US dollar and some precious metals like gold, and even Bitcoin has held up relatively well throughout this whole sort of attack on Iran.
Okay, so talk to me a little bit about that, because how have the flows been into gold? I mean, gold, particularly silver, although when I was noting some silver ETFs over the past couple of days, once we got this announcement, silver wasn't performing as well as I would have thought, but gold was. But gold has continued to perform well since the beginning of the year. But how are we seeing flows into gold? Is that still the favored hedge, do you think,
Absolutely.
in a time like this?
Absolutely. Gold has had a fantastic run up recently. And we think about everything that's going on with, the potential for a sort of a price shock in terms of energy prices, right? That's going to increase prices of oil, increase price of natural gas, and a whole host of other energy prices, which is going to spur inflation. And the question becomes, is that going to linger? Is it short term? And there's so many variables out there. Is how long does this attack on Iran last? What does the regime look like? What does the global growth look like? What does the energy infrastructure look like in that region? And that will sort of help dictate, what does growth look like going forward? Is inflation intact? Or is it something that's going to rear its head again, and something that we have to think about?
You mentioned Bitcoin, IBIT, that's the iShares Bitcoin Trust, largest Bitcoin ETF that we have. It was in the green. It went up during the Monday trading session, down a little bit today in the Tuesday trading session. Are investors right now thinking about crypto as a competing hedge at this time to gold, or is gold, I don't want to say the gold standard, that seems a little too punny. But how are investors kind of thinking about, what are the flows telling us in terms of the gold versus Bitcoin in a time like this?
I think it's a really hard question, because I think investors that purchase Bitcoin or other cryptocurrencies, the spectrum is so wide of why they use it. Is it speculative? Is it a hedge? What exactly is it doing in the portfolio? Is it an alpha drive? Is it a diversifier? So I think it's really hard to identify, is that a safe haven or not? It doesn't hurt that Bitcoin is substantially off its highs. So there's some people that are thinking, oh, wow, this is a good time to purchase. Is that a hedge? Is it a safe haven? I don't know. I don't think I'm to that point. I think that's why you're going to see a lot of individuals go into precious metals, into commodities, gold and silver, your traditional hedges against inflation and prices, oil prices and energy prices rising.
So let's talk about the oil and energy ETFs, because you were mentioning a little bit about the allocations broadly into commodities. But curious how you're seeing flows react right now in the oil and energy ETFs, and if you see a sort of tactical positioning because of this news, or do you think that there's a sort of allocation shift that's happening there in portfolios?
Well, I think we're as you mentioned in the introductory, we're only 3 or 4 days into this event, right? So I think when we look at ETF flows, I think it makes sense to think that we are going to see flows into some of the commodity products, specifically gold, oil, natural gas increase, right? And we're starting to see that. Again, it comes down to the supply chain disruptions, right? There is a very high likelihood that oil continues. The demand for oil, the growth internationally and domestic, is still in a good place. So we expect that the demand for oil going forward is still going to be there. Certainly the price action, we've certainly picked up some price in terms of oil thus far, so it might be a little muted going forward. But we think it's specifically for the next 3 to 6 months, oil prices and energy prices are going to remain elevated.
I want to talk about cash and money market ETFs, which are a fairly new product that the market has seen, these money market ETFs. In past times of crisis, investors have really decided to stockpile cash and now have the capacity to stockpile their money into these money market ETFs. Are you seeing that happening again this time around? Is that also of interest to a lot of investors now?
Yeah, it's a natural feeling when you have these geopolitical events and you see volatility extended, you see sell-offs in the equity and the bond market, you see 10% jumps in oil, right? The knee-jerk reaction is let's go to quality, let's go to safe haven investments, whether it be cash or commodities or what have you. And one of the things that I focus on as I head up ETFs at Advisors Asset Management is when we talk to financial advisors, it really comes down to time in the market and not timing the market. And this is a perfect example of why it's important to, of course, we want to look at the strategy. We want to make sure that the asset allocation makes sense. But in times like this, the market, both equities and fixed income, are generally very, very resilient. And that's something that we focus on a lot. So as much as it is the knee-jerk reaction to go to cash and sit on the sidelines.
Right.
It's really important to understand history. And what history has shown us over time is that when we have these geopolitical events, when we have historical events that happen like this in the market, markets are very resilient. In fact, if you go back to 1940, there have been over 40 instances that very, closely resemble this.
Right.
And what's really interesting is that in 67% of those times, if you look 3 months out from the time that these geopolitical or historical events occurred, 67% of the time, the S&P 500 is up. So instead of coming out of the market, take a breather, relax, make sure your asset allocation is intact. And even more importantly, if you look 6 months out after those 40 plus events, the median S&P 500 return is 5.3%. So if you jump out of the market,
right.
there's
Leaving money on the table.
there's a very good likelihood that the market is going to be more resilient than you think,
right.
and you're going to be leaving assets on the table. Now, that's hard to do. I totally get it. And we talk about, again, at AAM, time in the market, not timing the market, but we also talk about using levers, dialing up exposure, dialing down exposure. And when we have stressful events in the market, like we have today or this week, it is a good opportunity to capitalize on dialing up and dialing down exposure. So if you're interested in sort of reallocating your portfolio, there's a few things. Obviously, oil and energy stocks are going to be something that's going to be in favor that we think is going to have relatively nice gains going forward. But also look at defense and aerospace, right? When we have uncertainty in the market, there's going to be a tremendous amount of increased geopolitical risk, obviously security, defense. That's an area that we want to look at. And then we also mentioned precious metals, gold. On the flip side, if you're looking for areas to sort of tone down your exposure, take some off the table, obviously you have to start with mega cap US high tech companies.
And that's been in conversation for a long time anyway because of the concentration risk.
The concentration risk is real, right? We are seeing many investors take some of the exposure off of that, allocate to equal weight strategies where you're not, having a tremendous amount of exposure to the Mag 7. We're also seeing some individuals in this type of environment reduce their small cap equity exposure, right? That's an area that's often impacted most by these types of events. And then lastly, if you want to get a little more granular and focus about industries and subsectors, you have to think about airlines and consumer discretionary, right? As we saw with COVID, in environments like this, these areas obviously struggle quite a bit. Higher fuel costs, inflation, macro uncertainty. These are areas that, if you're looking to take a little off the table, that's an area that we think we should be doing that.
Speaking of strategies, I kind of want to ask about active. I don't want to make this the active versus passive debate. However, we have seen active ETFs pulling in a huge amount of flows since the start of the year. 37%, actually, I've written down as the stat. Now, S&P DJI has done a report on this every single year, the SPIVA report, where they've pretty much shown that passive always beats active. However, we still clearly see investor interest in active strategies. I'm curious to know if active in an environment like this, in your mind, does actually have an advantage over some of those passive strategies because of the capacity to do what you're saying, which is dial up and dial down in certain areas.
Yeah, as somebody that's been in the ETF industry for almost 20 years now, I've launched a number of rules-based passive solutions, as well as a number of active solutions. This is a debate that's only picking up. It will continue.
Right.
I think, before we get there, I think rising tide lifts all ships. And 2025 was a banner year for U.S. domiciled ETFs. We saw record inflows, we saw record launches, we saw record AUM. But we also saw record closures as well. And I think what we're seeing in 2026 is sort of an extension of that, right? 2025 was the year of active managers, right? We saw many traditional mutual fund advisors get into the ETF industry, right? I think after 15 or 20 years, the writing is certainly on the wall, right? This is a wrapper that's tax efficient, transparent, easy to use, low cost, and I think that you're seeing that transition. In terms of active management versus passive management, the answer, unfortunately, is not as clear cut as you may think. It totally comes down to what exposure are you looking for? Is that strategy best achieved in a rules-based strategy, right? That you can understand the logic and understand the methodology? Or are you going with an active manager that you trust to navigate these waters in these uncertain times? So I think the answer is both. But you really have to do the due diligence.
Right.
And as we have nearly 5,000 ETFs in the US marketplace right now, that is not an easy task for investors. So it comes down to doing your due diligence, understanding what you're looking for. But to your point, I think one area that is certainly picking up steam is active fixed income.
Yeah.
Not only on the retail front, but I'm having many, many conversations with very sophisticated investors, institutional pensions, endowments that are actually preferring their active fixed income exposure through the ETF wrapper because of the ease of use, the transparency, and the tax efficiency.
So speaking of fixed income always just makes me think of the Fed. And I want to ask you about the Fed because we have a Fed meeting in 2 weeks. Because I also want to ask you more broadly about your expectations for 2026. But I have to ask before we get there, again, Fed meeting on rates in exactly 2 weeks from today. With the oil prices rising, conflict right now seems to be continuing. We don't know for how long. Does this delay rate cuts? I think that's the big question on everyone's minds as we look out to this FOMC meeting.
I think this is a very tough situation for the Fed to be in, obviously, right? I think that's very apparent. What they are dealing with is a dual threat, right? Right here we have, energy-driven inflation and the potential for an economic slowdown, right? That's not a good scenario where you want to be going into lowering interest rates. Going into the meeting in a few weeks, I think it was a 50-50 coin flip if there were going to be a cut in interest rates. I think it's safe to say that this pressure, on the energy spike, and oh, by the way, the tariffs as well, I think is all in play here. And I think there's reason to believe that there is going to be a pause, right? There is no panic. I think there's going to be a time of trying to understand and grapple and understand what's going on in the marketplace. Do I envision, interest rate cuts in 2026? I still do. But with what's going on, with the reemergence of some areas of inflation, is it possible that we see a move in the other direction? That's something that's being talked about. This is a really tough situation, managing inflation, managing growth. It's a really tough place to be in. But I think as of right now, I think there will most likely be a pause in March, and we'll see what the future brings after that.
Do you think that we've already seen ETF adoption increasing every single year? 2024 was a record year, then 2025 was another record year. If it's still early into 2026, but we're already hitting record inflows. We hit them in the month of January, record inflows for just 1 month. So it seems like we're on pace for yet another record year. I'm curious to know if you think that ETF adoption is accelerated whenever we have these moments like this, because then stock picking just becomes so incredibly difficult for an investor.
I have this debate all the time with folks in the industry, and I'll be honest with you, I think we're still, as an industry, I think the US ETF market is still in the third inning of this game.
Yeah.
Right. I think we're still so early. As you mentioned, we see record growth, we see record AUM, we see record flows year after year after year. You mentioned January. We had over $160 billion of inflows in January. That's an 80% increase of what we saw last January. And oh, by the way, 2025 was a banner year.
Yeah.
Right? February is shaping up to be exactly the same. We've seen almost $350 billion of inflows in the first few months of 2026. We are well on a pace to hit a $2 trillion mark for 2026. The numbers keep growing. With that said, I do think environments like this does bring credibility to the wrapper. You look at everything that has occurred since the inception of the ETF, and the mechanics of the ETF has, for the most part, has worked as it has supposed to. And I think that the adoption of ETFs, the ecosystem that supports ETFs, when we talk about market makers, lead market makers, exchanges, everything is evolving. Am I concerned that we're moving very, very quickly? Absolutely. I think some of the things that have happened after the ETF rule in terms of launches, the barrier to entry, it has come down so low that many ETFs are getting thrown out there just to see if they're going to be successful. And again, that makes it very challenging for the end user, the investor. In fact, over the last year, we had 1,100 ETFs list in US exchanges. That's crazy. But we also had over 220 closures.
Right.
Like, that's a big number, and we should be thinking about that. You don't have to go back too far. It wasn't until 2019 that we actually had roughly 220 listings in the calendar year. And now this year alone, or actually the previous 1 year, we've had over 222 closures. So that's something that we think about. And I think there's always going to be an evolution. I think the ETF industry is on a very good footing right now. But when we talk about adding private credit into liquid vehicles, when we talk about COCOs, when we talk about other assets, we talk about jamming square pegs into round holes, it's something that we need to think about. And is this the best place for these types of assets?
Right.
Is that the ETF wrapper?
Right.
And that's a debate that we have often.
Right. Yeah, I've been hearing that question a lot. The ETF wrapper is not always the best wrapper for every single product.
I will say the ETF wrapper is a fantastic wrapper. Transparency, tax efficiency, ease of use, low cost. But for certain strategies, for certain asset classes, specifically those that lack liquidity, it may not be the best wrapper.
So last question for you, Lance. Just curious, we're looking out, it's still somewhat the start of the year. We're in the first quarter. As you look out to the remainder of 2026, I mean, we're talking now about the US and Iran, so geopolitical tensions. We've got the whole rate cutting cycle to be expected. What do you think a lot of ETF investors should really be thinking about or keeping top of mind?
As I mentioned earlier in the episode, stay your course. Do not, if you want to make slight tweaks here on the edges of your portfolio, do so. If you want to review your asset allocation, do so. But try to avoid any knee-jerk reactions. Again, it's time in the market, not timing the market. With that said, though, I think we alluded to it earlier. Active fixed income. I think short duration intermediate bonds is going to be a place specifically for active managers. A lot of investors are going to continue to flock to that area as we have elevated levels of uncertainty, volatility, and I think that's a really good place. And I think we will see many more flows into that area of the ETF market in 2026.
Well, definitely a good piece of advice for all investors to be reminded of, especially in times like this. Lance McGray, Managing Director and Head of ETF Product at Advisors Asset Management. Thank you so much for joining us today. And thank you so much for tuning in to the ETF Show.